Good morning, everyone. Today, my group is going to present on topic 1, taxation on leasing companies. I'm the first presenter. My name is Chia Pei Ying, metric number 255504. These are the agendas that we are going to include in our presentation, which is concept and definition, leasing and non-leasing business, tax treatment and scope of charge, and last but not least, the tax incentive available. Now, I'm going to start with the first part, concept and definition. There are several concepts and definitions that students need to understand before going deep into this topic. For your information, there are changes in the accounting standard for leases from MFRS 117 to MFRS 16. The new accounting standard for leases, MFRS 16, is applicable on or after 1st January 2019. According to MFRS 16, a contract is or contains a lease if it conveys the right of use asset for a certain period of time in exchange for consideration. This definition under MFRS 16 could be simplified into the diagram on the right-hand side. So based on this diagram, we can see that there are two parties involved, which is lessor and lessee. The lessor is the owner of the leased asset, while the lessee is the user of the leased asset. The lessor will convey the right to use the asset to the lessee for a period of time. This period of time could be in months or in years. In return, the lessee will have to make payment to the lessor for the use of the leased asset. The tax implication following the implementation of MFRS 16 could be divided into two parts, the lessor part and the lessee part. For the lessor, there is no changes in the tax treatment as the accounting requirement for lessor remain unchanged. However, for the lessee, they no longer can classify their lease into operating or finance lease. One good thing about the lessee is that they are allowed to claim the tax deduction based on the lease rental incurred. There is also interpretation of lease provided by the Income Tax Act 1967 and Income Tax Leasing Regulation. Under Section 2 of Income Tax Act 1967, lease include a sublease, a tenancy for 3 years or less, and any agreement for a lease or a sublease. Whereas under Regulation 4 of Income Tax Leasing Regulation 1986, define lease as any kind of arrangement or agreement in which the payments are made for the use of an asset. Besides that, students also need to know the definition for the lease term and special purpose asset. Lease term is defined as the period for which the lessee has contracted to lease an asset, or it could be a lease agreement has been terminated earlier than the actual period of the lease. The lease term could be classified into short term and long term. The short term could be 3 months or 6 months, while for the long term it could be 2 years or 3 years. Next, special purpose asset. Special purpose asset is also a lease asset in which there is no one can use the same asset without making any changes or alteration on the asset, which means that in a simple word, the asset is specifically designed for you and it should be a movable property. The example of movable property could be a vehicle, machinery, and equipment. Now, let's have a look on the Islamic leasing structures in Malaysia. In the context of Islamic financing, a lease contract is also referred to as ijarah. The ijarah concept is applicable in real property financing, vehicle financing, project financing, and personal financing. ITAP is a contract of lease that provides an option to purchase the asset at the end of the lease period. Under ITAP, there are two types of contract, which is leasing agreement and sales agreement. So this is the illustration of the ITAP agreement. We will start with the hirer. The hirer will first identify the vehicles to be purchased. After that, the hirer will approach an Islamic financial institution. So this Islamic financial institution will then conclude an Ijara agreement with the hirer. Under this agreement, the Islamic financial institution, which is also known as the owner, will appoint the hirer as agent to purchase the vehicle that is previously identified by the hirer. Subsequently, the owner will lease the vehicle to the hirer, and in return the hirer need to pay the monthly rental to the owner until the completion of the lease period. As for the sales agreement, upon the expiry of the lease period, the hirer is given option to purchase the vehicle from the owner. If the hirer chooses to purchase the vehicle from the owner, then the owner and also the hirer will conclude a sales contract. Therefore, the vehicle will transfer from the owner to the hirer. So this is basically a simple illustration so that you can easily understand what is in the ITAP agreement. And that's all from me for the first part, concept and definition. And I'm going to pass to my teammate for the second part, leasing and non-leasing business.
Moving on, I'm going to present about the leasing and non-leasing business. The separate business income is the requirement under Regulations 2 of the Income Tax Leasing Requirement. When a person is having leasing transactions and also other activities in his business, the gross income from the leasing transactions are deemed separate and distinct business source from the other activities. Next is the tax treatment gross income of the lessor. The total sums of rentals of the lease term receivables shall be deemed to be accrued evenly throughout the lease term. The gross income shall be a portion of the sum receivables by using the formula below. The number of days in that basis period divided by the total number of days as provided in the lease agreement times with the total lease rental receivable. There is an exception case where the full rental receivable may be treated as the gross income of the lessor without being accrued evenly, which is when the Director General considers that this treatment is just and reasonable. Going forward, this is the leasing business which I mentioned, the normal leasing transaction. In normal leasing transaction, the lessor can claim capital allowance on the asset. The lease rental that we receive from the leasing business is the income of the leasing business. And when the non-resident lessor leases an asset to the lessee in Malaysia, the non-resident lessor will be subject to withholding tax of 10% on the special classes of income. For the lessee in a lease transaction, the lease rental that they have incurred is actually a revenue expenses, so it is fully deductible to arrive at their adjusted income, and the lessee cannot claim capital allowance in lease transaction. Moving forward, when shall a lease agreement deemed to be a sales agreement, which is the non-lease transaction, where the lease agreements are deemed sales agreements. First, the lessee is given an option to purchase a sale agreement during the lease term or upon the expiry. So, this option is actually stated in their lease agreement, and this transaction will be regarded as a hire purchase transaction. This requirement notwithstanding that the lessee exercise the options or not, and the meaning of the lease term is the period which lessee has contracted the lease of an asset. The second criteria is when the lessee is given the beneficial ownership of the asset. So when the lessee has the ownership, the lease transaction will be regarded as a deemed sales transaction and not the normal leasing transaction. This can be applied in the sales and leaseback agreement if there is no capital allowance has been previously claimed by the lessee. The third criteria is the lessee during the lease term or upon expiry of the lease term acquires directly or indirectly the asset otherwise than its market value. The meaning of this criteria is the lessee has acquired directly or indirectly other than the market price for the asset during the lease term or upon the expiry. So each transaction will actually be treated as the hire purchase contract. Say for example, a machine was leased for 24 months with a monthly lease rental of 30,000 and the lessee was given the option to acquire it for 15,000 at the end of the lease term. This is a deemed sales agreement where the lessee is given the option to purchase at the price 15,000 is obviously lower than the market value because you can see that the monthly lease rentals is so expensive. So how can the asset become 15,000 at the end of the lease term? So this shows that the asset is actually not at the market value. The fourth criteria is the asset is a special purpose asset. So what is a special purpose asset? A special purpose asset is a lease asset where no other user can use the same asset without making alteration or without dismantling from a structure on land, and this asset is deemed to be a movable property. So a best example for this case would be a lift. You can see when the lift is structured into a building, it cannot be used for other users like other buildings without making the alterations, take out the lift from the building. So the lift is a special purpose asset. The fifth criteria is when the lessee has claimed the capital allowance in respect of the asset prior to the lease. So if the lessee has claimed, this will be treated as sales and leaseback agreement and not a normal leasing transaction. This is to prevent the lessee from claiming deductible expenses where the lease rental is deductible for them, and they will claim these deductible expenses after they have fully claimed their capital allowance. So IRB want to prevent these situations happen, so they have set the criteria that the lessee that claims capital allowance prior to the lease will be a deemed sales agreement. The last criteria will be the lessee is given the right to sell or dispose of the asset and receive the proceeds or a portion of the proceeds from the sale. In this case, the commissions that received by the lessor is excluded in the proceeds from the sale. So if someone is selling the asset by earning only the commissions, that would not be a deemed sales agreement. But when the lessee can sell the assets and receive part of it or the whole of the portions of the proceeds, it will be a deemed sales agreement. So what happens when it becomes a deemed sales agreement? The lessor would not treat the lease rental received as the leasing business, because the interest income will become the income that they receive from the lessee instead of the normal lease rental receivable. And the lessor cannot claim the capital allowance in deemed sales agreement. So whenever the one of the 6 criteria that I mentioned just now has fulfilled, the lessor cannot claim the capital allowance, and they will treat the income that received from the lease agreement as interest income instead of the normal lease rental receivables. When the non-resident lessor leases an asset to the lessee in Malaysia, they will subject to a higher withholding tax, which is 15%, because the withholding tax on interest is higher than the withholding tax on the special classes of income. So the lessee in deemed sales agreement can claim initial allowance and annual allowance at the prescribed rate on the cost of the outright purchase, and the interest portion that they have incurred is deductible.
Hi, my name is Yu Kali with metric number 255647. So in these sections, I will discuss further on the tax treatment and also the scope of charge for both lessor and also lessee. So we look at the lessor side first. So in these sections, we need to know a few regulations that will help us to determine the gross income for the lessor. So first, we look at the Income Tax Act, Section 24 plus subsection 1, subsection C, where in the relevant period, a debt owing to the relevant person arises in respect of the use or enjoyment of any property dealt with at any time in the course of carrying on a business, the amount of the debt shall be treated as gross income of the relevant person from the business for the relevant period. So in short, this section is basically talking about when the lessor has any receivable during the relevant period, he or she needs to include inside the gross income of his business. So the debt owing here means the receivable, any debt that the lessee haven't paid to the lessor. The relevant person here is the lessor, haven't paid to the lessor. So when the relevant person, which is the lessor, want to compute for their gross income, he or she need to take into the account of any receivable during the relevant period. Okay, so here are the links that you guys can have a better reference. Okay, so next is the Income Tax Leasing Regulation 1986 Regulation 3. So the total sum of the lease rental receivable is accrued evenly throughout the period of lease term. And next is the gross income of lessor for the basic period. For a year of assessment would be portions of the total sum receivable for the lease term. Okay, so the first paragraph here we discuss by using these two, which is the total lease term, which is 24 months, and the total lease payment is 50,000. So we need to accrue evenly throughout the period of lease term. So we use 50,000 divided by 24 months, then we will get 2,083 rounded off for each month, right? So for the basic period is 6 months. So when the lessor want to calculate for their gross income for the basic period, so we times 6 months. So we times 6 months, we will get 12,500 for the gross income. Okay, so in short, from the previous slide, we get the conclusions that the lease rental to a basic period can be calculated by using this formula shown here, which is the total lease amount in the lease term. We time with the number of the month being charged during that period divided by the total number of terms. Alright, so let's look at the example here. A machine A was leased out for a term 36 months. The lease rental to be paid by the local lessee would be as follows. Okay, so for the first period is 20,000, 30,000 for the second period, and the third period is 40,000. Right, so we'll get 1,080,000 for total 3 periods. So we get the conclusions that the lease rental is not evenly distributed. Okay, so let's see the explanation in the next slide. Okay, the lease rental are not evenly distributed and differ quite substantially in amount throughout the lease terms of 36 months. The total sum of the rental, which is the 1,080,000, shall be deemed to accrue evenly throughout the lease term. The likely treatment of income by Director General would be as follows. Okay, so looking at the period here, which is the 1st of April to 31st of March. So at 2019, the basic period is the period that the lessor pay the tax. Okay, is different from the period of the accounting treatment. So in the Director General side is the 1st July 18 to 30th of the June 19. So in this period only 3 months include. So the basic period is 3 months. How to get the 3 months is 1st of April, May and June. So is 3 months. Okay, same goes to 2020 is 12 months, 2021 12 months, and 2020 is 9 months only. So we use the formula previously that we will get a total of 90,000 for 2019 and 360,000 for year assessment of 2020. Same goes to the year assessment of 2021, which is also getting the 360,000 ringgit. And for the year's assessment of 2022, we will get a total of 270,000 ringgit. So we total out here, we also will get the total sum of the rental, which is 1,080,000. Right. Okay, so we move to the lessee side. For the lessee side, we will look at for the operating lease and also for the finance lease. Actually, both are the same. Both lease, the lessee can claim the capital allowance. However, for the finance lease, the lessee as well as can claim the interest expense incurred on the lease payment. So for this slide, it is the summary of the tax computation for the leasing company. So now, the question you guys can read by yourself. I will discuss for the answer for the next few slides. Before we look at this answer, we will move to the next slide first to look at the note 1, note 2 and also note 3 that we will be using it when we compute the complete answer. Okay, so we look at the note 1 first. Okay, how we calculate for the lease B. So for lease B, we look back at the information there, the description of the lease. Okay, B. It is at 3,000 per month for the first 24 months and 3,300 per month for the final 12 months. Otherwise, all rental remain the same throughout the lease term. Okay, so we need to calculate the total lease rental for the 36 months is how much. Okay, so the first 24 months time with 3,000 per month, we will get 72,000. Okay, 12 months time with 3,300, we will get 39,600. So total out we will get 111,600. Okay, so by using this number we divided by 36, thus we will get each month will be 3,100, right? Okay, because based on the regulation the previous slide had mentioned, we need to accrue the lease rental evenly throughout the lease period. Okay, so each month we will need to use 3,100 later when we compute for the gross income here. Okay, next, the month dues in 2018 is 9 months. This information can be get at the description of lease here, which is number of rental dues, which is month B, 9 months. Okay, so 9 months. So the rental for the year assessment of 2018, we use 3,100 per month time this time, and then we will get a total number of 27,900. Right, so moving on to the note 2, allocations of common expense and common capital allowance. So common expense, we need to divide the amount for the common expense and common capital allowance into for the leasing and also non-leasing. So the gross income, we look at the lease rental B and lease B and lease C. Lease rental for B, just now we have calculated, which is 27,900. We use that amount, we put inside here. C, we can get at the information there, which is the lease rental received in 2018 for C is 8400. Okay, 8400. The interest income for lease B and C we no need to take into account because it is leasing company. Okay, for non-leasing, which is lease A, why lease A is included at non-leasing? Because look at here the description of lease here. A, it results from a sales and leaseback arrangement. The asset was previously used by the lessee who suffered a balancing charge on the sale. So here are the keywords: sales and leaseback agreement. So it is non-leasing business. So it is under this column A. So for non-leasing, it will incur the interest income. Okay, so the interest income for A, that this amount 10,200 we will get it from the information at the question there. So the total gross income for leasing business will be 36300. For non-leasing will be 10200. Okay, so now we compute for the common expense and also common capital allowance. So the common expense, the total amount is 5,484. Okay, so how we going to divide it for the leasing and non-leasing part? So okay, for how we get this 4281 we will get it by using 36300, we divided by 36300 plus 10200. This amount is the non-leasing total gross income. Okay, so we will get this amount and then we time with this amount, which is 5484. So we will get this amount 4281. So the remaining amount will sure go to the non-leasing, which is 1203. So the same method will be used to calculate for the common capital allowance. So we get a total of 7,237 ringgit is for the leasing, and for non-leasing the capital allowance is 2,033 ringgit. So moving on, this note 3 here, we want to calculate the capital allowance for the leasing business. Okay, so we use the cost of asset at the questions there. For lease B will be this amount, lease C is this amount, so we add up, we will get 136,700. So based on the capital allowance rate, initial allowance we will use 20% and annual allowance is 40%. Okay, so how we get 27,340? We use 136,700, we time 20%. Okay, and for this amount we will get by using 136,700 times with 14%. Okay, so we will get this amount, and we add the common capital allowance, which is we calculate at note 2 here, which is this amount. Okay, 7,237. Okay, then we add up this, we will get the total amount of 53715. Okay, so now we will move on to the answer here. We will calculate for the statutory income for the leasing business first, and we will move on to calculate the non-leasing business. Okay, so we look at leasing business. The gross income we have calculated both. We have calculated it at the this one, note 1 there, calculated, which is 27,900, and lease C get from the questions 8400, so we get a total amount of 36,300. The deductible expense here we got it from the note 2 just now, which is 4,281. So we deduct this amount and we arrive at the adjusted income, which is 32019. So when we arrive at the adjusted income, now we were going to deduct for the capital allowance. At capital allowance here, we have both, which is the lease asset and also the other asset. Okay, so for lease asset, this amount we just now have already calculated at, we have already calculated at note 3 there. Note 3, this 0.34 is a percentage, which is the 20% plus the 14% just now, plus we time with the cost of asset. Here is the cost of asset. Okay, just now here, this part, the answer is this plus this. We will get the capital allowance for the leasing business. Okay, for the other asset capital allowance, this part, this answer we get from note 2. 7237, we get it from here. Okay, 7237. Here we less the utilization. Okay, so you add together the capital allowance. The total capital allowance that we have is 53715 actually, but the income that we have is 32019, so we only utilize the capital allowance that we get for by minus it 32019. We use this amount, we minus here, so we will left the capital allowance unused, which is 21696. Unabsorbed capital allowance will be carried forward for next basic period year assessment. Okay, so the statutory income left is nil, is 0. Okay, so we're moving on to calculate the statutory income for the non-leasing business. So for non-leasing business, the gross income incurred will be the interest income. This amount will get from the question, which is 10,200. Okay, we deduct the expense, which is also get from the note 2 there, 1203. Okay, then after we deduct, we arrive at the adjusted income. Adjusted income, which is 8,997. Then we deduct the capital allowance, which is also we have calculated at note 2 there, which we will get 2033. Okay, so after deduct the capital allowance, we will arrive at the statutory income. Okay, so after we calculated for the leasing business and non-leasing business statutory income, we will add together for the leasing business and also non-leasing business. We add together 1 plus 2. Since the statutory income for leasing business is nil, so the aggregate statutory income will be 11030. We minus the unabsorbed business loss, which is from the question, unabsorbed business loss, which is 866 minus, then we will get 10,164 minus approved donation 686, then we will arrive at chargeable income, which is 9,478. This is the income that will be charged to tax. Okay, now we move back to the note 3. Here is this part. We minus the amount utilized, which is just now this part Amount that we utilize is 32,019 ringgit. So we utilize it, so we minus it to 32,019. So we total up. Unabsorbed capital allowance carry forward will be 21,696. So that's all for my part. So I will pass to my other group mates.
Hello everyone, now I will present about the tax incentive available for the leasing company. The tax incentive available for the leasing company can be divided into two types. The first one is the tax incentive for the lessee, and then the second one is the tax incentive for the lessor. For the lessee, the main benefit that will be get by them is the capital allowance. The capital allowance is something that can deduct a number of costs associated with a piece of equipment from the taxable profit on the annual basis. The capital allowance can be applied to the outright purchase, hire purchase, and under a loan funding leases. Now I will show you a table about the capital allowance rates for the different types of the assets. From the table, we can clearly see that the initial allowance for the assets is all the same, which is around 20%, but there is a difference in the annual allowance. The annual allowance for the motor vehicle and the heavier machinery is around 20%. For the general plant and machinery is around 14%. For the office equipment and the furniture and fixtures is around 10%. And the last one for the computer is around 40%. Next is the tax incentive for the lessor. The tax incentive for the lessor can be divided into four types. The first one is the lessor can decrease the taxes on the defaulting client. If the client made something wrong on the lease, then the company can claim the losses of the income from the lease as a tax deduction. And then the second is the lessor can claiming back on the maintenance cost. Even though the equipment is used by the other company, but the lessor is still the owner of the equipment. So any cost that incur and associated with the lease asset can be claimed by the lessor, especially the maintenance cost. The third one is to reduce the interest cost. The lessor is allowed to take a loan for the purpose to cover the majority cost of the equipment before the equipment is leased out, especially when the lessor is decided to lease out a new equipment. So this will allow the lessor to get the lease payment and at the same time to cover the interest payment of the loan. The last one is the equipment upgrade. If the client requests for the equipment upgrade, then the lessor can assume that the older equipment is not longer for standard and claim for the tax deduction. After the clients return back the equipment, the company can claim additional tax deduction if they donate the older equipment. There are some additional leasing benefit that can be get by the leasing company. The first one, the company for the green technology service will get a 100% tax exemption on the statutory income for a period of 5 years. So, what is the green technology service? The green technology service is a business that relates to the renewable energy, the electric vehicle, and also the energy efficiency. Next, for a company that undertake the solar leasing activity, they will also get the 70% of income tax exemption for a period of 10 years. The leasing company will also gain the access to equipment at a lower cost than a loan. And then the lessee will also having the right to terminate. At the end of the lease term, the lessee will give the opportunity to see whether they want to continue the use of the equipment or they want to end the lease. So they have the ability to make a decision either want to take over the ownership of the equipment or want to change the equipment to another equipment. The last one is the lessee can take the advantage for the latest technology. Nowadays, many lessee they like to invest a lot of money in the equipment, but this will give some advantages to them, which is the equipment maybe will out of debt before the equipment is paying off. So it is better for the lessee to sign a lease for a fixed period, and after that they can upgrade or change the equipment when the lease term is expired. Before I turn to the next slide, I want to briefly explain a little bit about the situation of the lessor in Malaysia. For the lessor who carry out the business in Malaysia, they have the same objective with the lessee. which is to measure that the deal sale agreement that stated in the Regulation 4 does not apply. This is because lessor want to claim the capital allowance for the purpose to settle its lease rental received or receivable from the leasing company, while the lessee prefer to claim the lease rental deduction rather than the capital allowance. However, the situation will be totally different if the lease agreement involves the foreign lessor. So the next subtopic that I want to present is the cross-border lease. The cross-border lease is a leasing agreement where the lessor and the lessee are located in different countries. It is also the agreement where the foreign lessor does not have the permanent establishment or does not carry out the business in Malaysia. This type of the leasing is widely used in the European country, especially between the European country and the United States, for the purpose to show the difference in the tax law in different countries. There are some tax treatment that can be used by the cross-border lease. The first one is the lessor for the cross-border leasing is unable to claim the capital allowance, even though it is in the non-deal sale situation. The second is the foreign lessor will be more preferred on the deal sale situation because the withholding tax is only according to the interest element as compared to the withholding tax on the lease rental in the non-deal sale situation. The withholding tax will be arise when the lease rental is paid to the offshore lessor. According to the provision of the Section 109 and 109B in the Act, the withholding tax rate can be divided into two types, which is the 10% for the royalty and moveable asset, and the 15% is for the interest element. That is all from our group. Thank you.